Our FIRE is not financial independence retire early, but financial independence for recreational employment. Hey y'all! Welcome to my channel. I'm Pancute. I wish all of you a happy new year. As we've looked back at past year and observed what we accomplished in 2022, I'm so excited that our family, we managed to save $102,000 in 1 year. In today's video, I'm going to break it down for you where we saved our $102,000 and our investment and saving decisions to give you some food for thought. I'll also touch on some changes introduced by the recent $1.7 trillion of an omnibus spending bill that might affect your financial planning once the bill is in effect. Towards the end of the video, I'll also talk about our budget methodology, as well as some of the misconceptions that I had when I first began budgeting. Today's going to be a juicy one, as I've packed a ton of great information in this video, including the logic behind investing in stock market versus real estate. But before I do that, I must give a disclaimer. This video is not meant to give you any investing advice. It's for education and information purposes only. This is a snapshot where we put our $102,000 savings in 2022 alone. One thing I want to point out here is my husband and I, we got married in 2018, and I am managing all of our accounts. The most important thing in a relationship is building the trust, including your finance. If you are in a relationship with someone but you guys are not married or engaged yet, you probably don't want to combine your finances yet, but I highly recommend you open a joint savings account. When you get married, some people say, oh, you have the freedom to either combine or separate your finances. I would want to argue against that, and the reason is, unless you guys file married filing separately on your tax return, the IRS will view you two as one person anyway. It doesn't matter how you guys manage your money. Your finances are bound together from the day you got married. Although you should still have one savings account for yourself in marriage, you need to have a conversation with your spouse if you have not, and you two need to develop a plan to get on the same page. Although today's video is to talk through our $102,000 savings in 2022, I don't want you to feel pressure to do the same because it took us years to get to this point. Okay, without further ado, let's dive in. First, our 401k. I changed a job in June earlier this year. My previous employer offers a 25% to my contribution up to 6% of my salary, starting my second year of employment. It was also subject to a very strict vesting schedule. I didn't get much anyway when I left the job. Sometimes if you get a huge jump in salary when changing jobs, you don't have to wait for the employer contribution to be fully vested, as it's probably not worth it. But of course, it depends, and you need to do your due diligence. My current employer offers a 50% match to my contribution up to 6% of my salary, and it's vested immediately, the same as my husband's plan. I'm sticking to a traditional 401k plan, while my husband split into a traditional and a Roth account, including employer contribution. Our total 401k contributions in 2022 are almost $31,000. For the most part, we invested in index fund like an S&P 500 index fund, small cap index fund, but we also invested in some individual stocks via a self-directed brokerage account of my husband's 401k plan. If you are new to workplace retirement plans, with non-Roth accounts, you deposit money in such a way that you avoid paying income taxes that year, and when you withdraw money, then you pay income taxes according to your income tax bracket at that time. With Roth accounts, you deposit money and pay income taxes on it that year, and when you withdraw money, you don't pay taxes on it, including the earnings. Employer offers matching contributions to a Roth 401ks the same way as traditional 401ks. Currently, that match contribution has to go into a traditional 401k account, but the new bills give the employer the option to let the employee choose between putting the match in a traditional or Roth account. If you think the content is helpful, please give it a thumbs up. Next, let's talk about my Roth IRA. In 2022, I contributed $6,000. I had to use a backdoor IRA to achieve this. That's because our income, to be accurate, our modified adjusted gross income exceeds the threshold set by the IRS that one can directly contribute to a Roth IRA. I'll explain in a future video in detail about a backdoor Roth IRA. I'm investing in an S&P 500 index fund. Starting 2023, the contribution limit will be $6,500. Note that you can contribute to multiple IRAs if you want, but $6,500 is the limit for your contributions to all IRAs combined. If this is the first time you are shopping around and are looking for a place to open an IRA or Roth IRA, you might find out the popular broker Robinhood just introduced a feature that no other broker offers. An IRA with a match. It sounds fascinating, right? As of December 2022, Robinhood users can sign up on the waitlist for an IRA. But you need to be wary of Robinhood's reputation of gamifying investing and trading. So my husband has a brokerage account at Robinhood, so we know how easy it is to get into trading at Robinhood. I want to caution you the risks of short-term trading. Also, Robinhood is lack of diversified investing options like the other brokers such as Fidelity. There are quite a few differences when you compare a Roth 401k to a Roth IRA, which is worth a separate video, but here I do want to mention you must start receiving required minimum distribution RMD from a Roth 401k at a certain age as you would with a traditional 401k. With a new bill, however, Roth 401ks would have the same rule as Roth IRAs starting in 2024. For a Roth IRA, you are not required to withdraw money at any age, so no RMD for Roth IRA. Now let's talk about HSA. In 2022, we contributed $4,700 and my husband's employer also contributed $2,600 to his HSA. That gave us a total of $7,300, which is the limit for a family for 2022 set by the IRS. I had a video in which I talk about what is a health savings account and its quintuple tax benefits. I will link the video in the description, pinned comment. So you can only contribute to an HSA when you are enrolled in a high deductible health plan or HDHP. I talk in the video when an HDHP can be a great choice for you or your family. While we're contributing to an HSA, we also utilize the two special FSAs, flexible spending account in conjunction with the HSA. I talk more about this as well as what we invested in the HSA in my previous video that you can check out. As we talk through these retirement plans, I want to remind you, make sure the right people are under the beneficiaries. Revisit when you have a life-changing event like marriage. Let's move on to stock plan. If you work for a public traded company, you likely know what an employee stock purchase plan or ESPP is. An ESPP provides eligible employees with an opportunity to purchase their company's stock at a favorable price through periodic after-tax payroll deduction. Employees can elect to participate or not during the enrollment period, usually twice a year, and can stop at any time. Take my husband's company's ESPP as an example. Participants can elect to contribute between 1% and 15% of their salary to the plan at the end of each 6 months purchase period. The money they've set aside is used to buy stock for them at a discount of 15% of stock price. There is a complication how to determine the stock purchase price that I'm not going into detail in today's video. My husband elected to contribute 15% of his salary in 2022 while he's subject to an annual dollar limit. You saw this small amount in this line. That's because once the stock is purchased, it's put into a Fidelity investment account the company set up for him to hold or sell, similar to my husband's RSUs, restricted stock units, that are also put into the same Fidelity investment account when they are vested and released to him. People tend to associate income with cash. That isn't the case with RSUs or the stocks you bought through an ESPP, Employee Stock Purchase Plan. You report income and pay taxes even though you haven't sold your stock. My husband will need to report about $26,000 of compensation income from his stocks for 2022. We sold my husband's stocks in the ESPP and RSUs that were vested in 2022. We reaped the capital gains, but I did not include any gain in this number because I wanted to track how much money we've earned and saved in 2022 in this schedule. We have the proceeds in the money market fund. Well, we only reinvested a portion of that. Starting September 2022, every month we invested $2,000 into a Fidelity Zero Total Market Index fund. So that gave us an $8,000 invested as of the end of December. I myself also elected to contribute 15% of my salary to the SPP provided by my current company during the enrollment period later in the year. I also have $1,780 deposited in my E-Trade investment account that's currently in cash. The next one is the most hurtful. We opened an account at Robinhood in 2021 under my husband's name, and we started investing in crypto. In 2022 alone, he deposited $11,600 into the account. Most of that was used to buy Ethereum. In 2021 and 2022 combined, we put in $25,000 in Robinhood account that has dipped below $14,000 as of the end of 2022. Needless to say, we're underwater on this investment. As a result, we sold 2 coins at year end because we wanted to capture some capital loss on the 2022 tax return, known as tax loss harvesting. Let's move on to the next. Recently, we all saw blue chip stocks plummet. I can't let go of this opportunity, so I opened my second TD Ameritrade brokerage account, a joint account with my husband. In November 2022, we transferred $6,000 into the account and invested $4,500 of that in some FANG stocks that I will talk about in the upcoming video. So that left us $1,500 in cash position. Additionally, I invested $6,000 in another investment account, not a brokerage account though. Maybe I'll disclose that in the future. Okay, let's move on to 529 College Savings Plan is a state-sponsored investment plan that enables you to save money for a beneficiary and pay for education expenses. When you withdraw the funds as tax-free for federal tax purposes, it might provide additional state tax benefits depending on your situation. Our daughter was born in February 2020. In June 2020, we opened a 529 plan at Vanguard for her and made a $3,000 initial investment. And ever since then, we contributed $200 to $500 each month. In 2022, we contributed $5,300 in total. Combine that with what we did in previous 2 years, we've contributed $11,000 so far for her. I often hear people say you should prioritize your retirement accounts before your child's education. I want to challenge that point of view because it's very likely that you have a longer time horizon to contribute to your retirement accounts than your child's education. Of course, everyone's situation will be different. For us, we're contributing to both types of accounts at the same time. Another concern parents have that made them for decades avoid putting money in 529 college savings accounts is the scenario if they don't need the funds for higher education expenses and they want to withdraw the funds someday. For instance, if the child doesn't go to college. With the new bill, many families with leftover 529 savings would be able to move to a Roth IRA. Although there would be a dollar lifetime limit on the transfers per account beneficiary. Finally, our bank checking savings account. After we contribute to those retirement and investment accounts above, I monitor the cash flows in all of our bank's checking savings accounts plus certificate of deposits. It turns out the aggregate cash flow is a negative $2,800. Meaning we did not save extra money in 2022 in these accounts, and we actually spent $2,800 of a prior year savings. I'll talk about the tasks we assigned to all our savings checking account in a minute. Hang on. So far, we've broken down our 2022 savings of $102,000. So in 2021, I felt the valuation of assets were a little too high, so we sold a small portion of our investment in some brokerage and retirement accounts and get into cash position. It's only a small portion though. Now we put some cash position back into stock market in 2022. That includes my first TD Ameritrade account that I opened in March 2020 and have used the account to invest in individual stocks. Also, through my husband's 401k plans brokerage link, we used about $3,000 that was accumulated in prior years and bought a few individual stocks. To know what a brokerage link is, I'll link a video in the description and the pinned comment. We used the cash in my husband's IRA and my Roth IRA to buy some ETFs. In total, we invested $29,000 that were accumulated in cash positions in these accounts in prior years. In a summary, in 2022, we invested a total of $110,000 in stock market. We'll exclude these blue color remarks. Now let's talk about our savings for other goals. We have a checking account from which we draw money and pay our day-to-day expenses, plus another checking account designated for sinking funds only, and another $8,000 what I call the buffer checking account. We've also have to build an emergency fund of 6 months of our living expenses that's currently saved in a CD. Besides, throughout years, at the end of 2022, we've saved $116,000 for a down payment of a rental property we're planning to buy in the future. So we did not have one designated savings account for this, but I have it saved across a money market fund in my husband's Fidelity investment account,
as well as a high yield savings account. Periodically, we do transfer the money out of that account
and put it into another saving account. Last time when we did it was June 2021. We haven't transferred any money out of his account in 2022 because we saw the stock market crash in 2022. Earlier, I mentioned each month we invested $2,000 in a total stock market index fund starting September 2022. I made a video showing you how to set automatic investment with Fidelity. I'll link it in the description. We're planning to invest another $4,000 in the stock market in 2023 within his account, and then we'll transfer the leftover money in the money market fund of his account to another savings account and get ready to invest it in the rental property when the time is right. Here's how I view investing in stock market versus real estate. Stock market is always forward looking. You see stock market have a sharp decline before we even enter into a recession, and that's why we prioritize it when we saw an opportunity to buy into stock market at a discount price. When it comes to real estate market, we usually see a decline in home sales before we see a drop in home prices, and location is the most important factor. I live in Silicon Valley, California, and I already saw a greater than 20% drop in home prices in many locations. How far home prices dip in 2023 will likely depend on where mortgage rates go. It's virtually impossible to be able to constantly time the stock market, but on the other hand, I would attempt to time the housing market. As the US economy is expected to go into a recession in 2023, we'll see further drop in home prices, especially Silicon Valley is the tech hub where we are seeing the most layoffs, and we'll see more in 2023. With that being said, I don't think we'll buy a rental property in 2023, but more likely in 2024. Therefore, one of our goals for 2023 is to continue saving even more aggressively for our rental property. When I first started budgeting, I tried what's called Pay Yourself First budget that I had read from multiple sources, but it did not work well for me. I was internalizing for a while before I tried another method, which is my current modified version of a zero-based budgeting. I won't be able to get into detail in today's video. The problem that I had when I tried applying Pay Yourself First method is I couldn't help being too aggressive on how much I should allocate to my retirement fund. So I often got tired and confused. Don't get me wrong, retirement is important, but it's not our only goal. Our fire is not financial independence retire early, but financial independence for recreational employment. What about you? Please comment down below. The point is to make sure your money decisions align with your values and goals. People's core values shift over time and they're often not what they used to be. When you have multiple goals and a budget that stretches so far, every goal can't be the most important one. Budgeting starts with identifying your goals and prioritizing based on importance, cost, and when you want to achieve them. As new goals are entering the picture, you are going to reprioritize. You always need a plan to guide you what step to take next so that you can stay focused on what you want to achieve, especially when you have competing goals. Thank you so much for watching. If you think the content is helpful, please hit the like button. That helps my channel a lot. And thank you. My channel is all about investing, taxes, and personal finance. If you are interested in these topics, please consider subscribing my channel and turning on the notification bell. I will see you in my next video in which I will talk about the individual stocks we bought in the past year. Thank you. Bye.